This audio podcast is brought to you by ETFdigest.com. Check out Dave's new book, Create Your Own ETF Hedge Fund, a do-it-yourself ETF strategy for private wealth management. Now here's your host, Dave Fry.
Well, good afternoon, everybody. It's Dave, Friday, January 23rd, 2009. I'm here with my good buddy Greg Newton of NakedShortsTypepad.com, who just got hearted and written up as one of the best financial blogs on Wall Street. How you doing, Greg?
I'm doing great, Dave. Hi, everybody.
Let's see. The S&P was off 2%. NASDAQ down 3.4%. Dow Jones down 2.5% for the week. You know, my thoughts are that they've been taking various sectors or companies out and shooting them, and only for a few days later to rally another sector to keep that 8,000 Dow level from collapsing, because I think if it does collapse or just settle through there, we may have even more downside to go. Greg, what do you think about GE was the candidate today for slaughter, but...
Yeah, you hit your number, but you do most of it by bringing in tax benefits from previous years. As earnings quality goes, that doesn't really cut it. But it closed just over $12 today, which means it's probably the only AAA rated investment in the world paying 9% at the moment. You know, back up the truck, everybody.
Loaded. Doesn't Buffett own some of this by now?
Buffett put in his money about $2 or $3 trillion ago, so...
Well, if they gave him a preferred stock and he needed it, they'd have to pay him like, what, 12% maybe?
Unbelievable. You know, I was thinking to myself, gosh, this is starting to feel like October. You know, when we open up, you know, we welcome the new president by blowing off 300 points, and then the next morning you get I think it was IBM, and forgotten who the other one was, came out with results that were not as bad as could have been expected, and we rally them back 280 points the next day. It started to feel just like roller coaster October again.
Yeah, where we have these 300 to 500 point intraday swings. I believe the stock you're thinking of is Apple.
That was it.
You know, we're a nation of pod people. We don't do anything else except walk around with iPods and iPhones, and that's the state of our country, I guess, at the moment, huh?
It's the state of something, but, you know, some of the stuff that was going on this week was probably the state of stupidity, but it was nice to see some gratuitous market violence back in the scene.
Well, you know, let's get right to gold. I'll probably be back in gold. Very frustrating to have been stopped out of it. Now I'm going to have to get back in it again, and I think what's going on is the currency markets are just totally screwed up. You know, a British pound has been just totally slaughtered. People are talking about the dollar index as just being really needing a major reconstitution. But, you know, the dollar's been doing reasonably well. I know it flipped around a little bit today. But, you know, I think people are basically pretty frustrated with currencies in general and the direction of markets overall in terms of policy. They just said, oh, what the hell? We just got to own gold.
The dollar was pretty flat on a net basis, but gold was up $40. But early in this week, you know, the rest of that big run this week came in the back of an advancing dollar. So it's interesting to see gold behaving the way it is in this particular climate, because theoretically a strengthening dollar is bad for gold. That's been the rule of thumb.
Right.
But we also had oil do a big turnaround bright eyes today too. It was down. It was starting to look as though it was heading for $40 again. Obviously we had the contract switch out on Tuesday, I believe it was, where we saw the March come on the board Wednesday, and it looked as though this morning it was sniffing out that $40 level again, but that turned around and it finished up around $45, $46. So, you know, today was the day the resources got bought fairly hard, and that was where some of the advances came from. It's going to be interesting to see what happens next week, because the oil companies start reporting. Now, with oil where it is now compared with where it was even at the back end of last year, I think we're going to see some fairly heavy misses among some of the major oil companies. I don't think Exxon's going to be turning in too many $10 billion quarters this year. So it's possible that I would not be at all surprised to see the energy stocks get taken out the back next week. But as the man from Wharton will always tell you, the price is already in the market, so we'll see.
What did you think of that story that I posted about Citigroup, I believe it is, and Morgan Stanley buying containers and ships full of oil, funding that, and putting them offshore to take advantage of the current contango in the market, where, folks, if you're not familiar with that, it's not a dance, even though I'm in South America. It has to do with the fact that the back months are at much higher price levels than the front months. And the theory here is that if you buy a container full of crude oil, you can leave it, park it offshore somewhere in some secure area of the world, if there is such a place, then deliver it later at a much higher price and pocket the difference. And God bless the taxpayers for giving these companies the money to do something like that. Did you see that story?
Yeah, that's been a trade that's been going on for a little while now. The part of Citi that's doing that is in fact the old Phillip Brothers business, who were great commodities traders and were eventually taken over by Salomon Brothers. I mean, that one goes back 25, 30 years, but Phillip Brothers' operation has always been a quiet little part of Citi that's been making rather more money than the rest of it. And it's a trade that's made possible by the contango, and especially with the contango, I haven't looked at in the last couple of days.
Oh, it's really a big difference, a major difference.
It was almost 50% a few days ago. So if you're holding costs, and of course with the global economy slowing down so much, it's a lot cheaper to rent super tankers than it was 12 months ago.
Yeah.
So your storage costs are a lot less than the difference in the price between the front end and the back end of the curve. And you lock in those profits, and all you have to do is sit on the oil for 12 months. Unfortunately, filling up a tanker with oil and renting it is something beyond my means at the moment. But,
we could put an ETF together for that. What do you think? A leveraged one.
Well, yeah, one of the problems that this super contango is causing is in the behavior of the oil ETFs as they roll forward. They're having to sell 33 and buy it back at 44 sort of thing. So the tracking on those things hasn't been too brilliant. Sometimes ETFs are not, in fact, the answer to a maiden's prayer in capturing some of these movements.
Yeah. The ETF that's been driving me crazy in that area in energy is the XLE. XLE is just the most annoying chart I've looked at in a long time. And it has these, if you've seen me post it, folks, and those huge tails that are in the candles in the charts I've been posting on the monthly charts. Those tails really tell you that there are a lot of people, with a really strong bid under the market, and they're not letting it fall. But that if I draw that $50 line for XLE one more time, I'm just getting sick of it.
You are listening to Market Summary Broadcasts with Dave and Greg.
Richard Parsons is now going to head Citigroup as the chairman, and I thought that was almost ridiculous since he was the one in charge of destroying Time Warner pretty much, other than the internet itself. Then the other thing, of course, was the John Thain and Merrill Lynch crap that took place this week, where Thain at first redecorated his office for $1.5 million. I mean, most people their dream homes would cost $1.5 million, but Thain's office was $1.5 million or some such crazy number. And then, of course, it was revealed that 3 days before the collapse of Merrill or the deal with the Bank of America, they paid out big bonuses to senior staff. Do you have any more information about that?
Yeah, the Merrill advanced its bonuses to its staff. They normally pay them either end of January or the middle of February, and with the Bank of America transaction coming up, I suspect that Mr. Thain decided that he'd pay his people before Bank of America swooped in and cut all his numbers by probably 60 or 70%. There are some questions. The Attorney General of New York State is looking at that. I don't know what's going to come out of that. Some of that number has also been sort of fairly misconstrued. The realities is outrageous as it was, but there's a lot of Merrill paid $15 billion in total comp last year, and of that, I believe that the bonuses were about $3 billion. Everybody was jumping up and down about the fact that the company lost X billion dollars and still paid out. This total comp figure was only down by 6% or something. It's bad enough, but it wasn't quite as bad as it was portrayed in some areas. But I think what we're seeing with what went on at Citi this week, what went on at Merrill and the Bank of America, is that it's just a comment on the management of these companies, period. These organizations are arguably too big, but what we really see is companies admitting that the people who were running them just have no clue as to what's going on.
Well, that should do it for this week, folks, and I'm going to be traveling next week, heading up to Washington, D.C. We won't have a podcast next week, and that is my birthday present to Senor Greg Newton, whose birthday it is this coming week, so we wish him a happy birthday. And Greg, thanks for being with me.
My pleasure, Dave. Thanks for listening, everybody. And it sounds like we won't talk to you next week, so we'll catch up sometime in February.